Thank you, and welcome back to the Briefcase, where we talk all things business, investing, and real estate. Today we'll be talking about how to analyze any real estate deal like a CPA. This is the step-by-step framework. Now let's get into it. 99% of real estate investors are terrible at analyzing deals, and it's quietly costing them thousands, sometimes tens of thousands, on every single property. And the worst part, they don't even realize it. They're looking at the wrong numbers, ignoring the tax side completely, and making decisions based on surface level metrics that look good, but don't actually hold up. Now here's the difference. Because the deal that looks good to most investors can actually be terrible, and a deal that looks average can actually be a wealth building machine, if you understand how to analyze it correctly. So in this video, I'm going to walk you through the exact step-by-step framework a CPA would do on a real estate deal like this. By the end, you'll know, without guessing, whether a deal is worth buying. So let's get into it. Step 1. These are the numbers that matter the most. Let's start with the foundation, because this is where most people go wrong. They ask only one question. Does it cash flow? And that's not enough. Cash flow is the result, not the analysis. If you want to think like a professional, there are 3 numbers that matter the most. This is net operating income, cap rate, and cash on cash return. Let's break this down with a simple example. The purchase price is $500,000. The monthly rent is $3,500. The monthly expenses, $1,200. First, we'll do the net operating income, or the NOI. The NOI is your income after operating expenses and before debt. So $3,500 minus $1,200. This is $2,300 a month, and multiply that by 12. That's $27,600 per year. That's your net operating income, or NOI. Now let's do the cap rate. The cap rate tells you how the property performs, independent of financing. So $27,600 divided by $500,000. That's about a 5.5% cap rate. Now here's where people mess up. They think, okay, cool, I'm making money. But what they should be asking is this a good return for this market, this risk, and this asset class? Because a 5.5% cap rate in one market might be great, but in another, that's overpriced. Now let's talk about cash on cash return. This is where financing comes into play. Let's say you put 20% down. That's $100,000. Now after your mortgage payments are paid off, let's say you're still left with $6,000 per year of cash flow. So that's $6,000 divided by $100,000. That's a 6% cash on cash return. Now that we have context, and it's not just it cash flows, but actually how well it performs, it shows the shift from guessing to analyzing a property. Step 2. The tax strategy most investors ignore. Now here's where things get interesting, because this is where the CPA lens changes everything. Most investors stop at cash flow, but professionals ask, what happens after taxes? And most importantly, how do I optimize those taxes? Let's talk depreciation. The IRS allows you to depreciate residential real estate over 27.5 years, and commercial real estate over 39 years. So even if your property is going up in value, on paper, it's losing value, which means you get to write off a portion of it every year. Let's say out of a $500,000 house purchase, $400,000 is allocated to its building. Divide that by 27.5, that's 14.5 per year in depreciation. Now here's the magic. Let's say your property makes $6,000 a year in cash flow, but you have $14,500 in depreciation. On paper, you're showing a loss, which means you could pay 0 taxes on that income, and in some cases, even offset other income. Now take it a step further. Bonus depreciation. Depending on the deal structure and cost segregation, you can accelerate depreciation into the early years, meaning you could shelter even more income faster. And this is why I always say, A deal that looks average on paper can become incredible after tax advantages because you're not just earning money, you're keeping more of it. Step 3, risk analysis. Now let's talk about the part no one likes to think about, risk, because every deal looks good until something changes. So let's stress test it. First, vacancy. What happens if rent drops 10%? Your $3,500 becomes $3,150. Now your net operating income shrinks. Your margins get tighter. It's suddenly that safe deal doesn't feel so safe. Secondly, interest rates. If you're using debt, your deal is sensitive to rates. If rates go up, your payments go up, and your cash flow gets squeezed. Now here's the real question. Does your deal still work if things don't go perfectly? Because they won't. Thirdly, locational trends. Is this area growing? Is it stagnant? Or is it declining? Because real estate is not just about property. It's about where property is. Population growth, job expansion, and infrastructure. These are the forces that determine long-term value. And if you ignore them, you're not investing. You're gambling. Step 4, the deal decision framework. So now we bring it all together because analysis without a decision framework is just information. Here's the exact checklist I personally recommend to use for any deal. First, cash on cash return. I want a minimum of 6 to 10%, depending on risk. Second, the cap rate. Does it align with the market? Am I buying at a fair or discounted valuation? Third, tax efficiency. Can I use depreciation to reduce my taxable income? Fourth, risk buffer. If rent drops, if expenses rise, does the deal still survive? And finally, does this deal align with my strategy? Because not every good deal is a good deal for you. And that's the difference between amateurs and professionals. Professionals filter deals. Amateurs chase them. Let me walk you through an example. This example is a $500,000 purchase price, $3,500 rent, and $1,200 expenses, same as earlier. We already know net operating income is $27,600, and the cap rate is 5.5%. Let's assume financing leaves us with $6,000 with cash flow, so 6% cash on cash. Now the tax side, $14,500 depreciation. So we're likely paying little to no taxes on that income. Now risk. If rent drops 10%, cash flow shrinks significantly, but still positive. If rates rise, margins tighten, but don't collapse. So would I buy this? Here's the honest answer. It depends. If this is a stable, growing market with a long-term upside, yes, I'd consider it. If it's a stagnant area with limited growth, I'd pass. Because the numbers alone don't make the decision. The context does. Lastly, let me run you through a quick fun fact before you leave. This one might completely change how you look at real estate deals. Did you know 2 investors can buy the exact same property for the exact same price, and one of them can legally pay 0 in taxes on their income, while the other pays thousands? And no, it's not a loophole. It's just understanding the numbers like a CPA. Here's why. Real estate isn't just about cash flow. It's about something called phantom losses. Through depreciation, the IRS lets you write off the value of your property over time, even if the property is actually going up in value in the real world. So on paper, you might show a loss, while in reality, you're making money every single month. That's why when professional investors analyze a deal, they're not just asking, does this property have cash flow? They're asking, what does this property look like after taxes? Because sometimes the best deals aren't the ones that make the most money. They're the ones that keep the most. And that's the mindset that you need to keep when investing in commercial or residential real estate. Thank you for watching. Now, if you have any insightful or confusing thoughts about net operating income, cap rates, or cash-on-cash ratios, please comment them down below. And if you liked this video, make sure to like it and subscribe. Now remember, stay smart.